Good morning or good day, my friends. Sorry, I was away for the last 2 days attending to something. We are back. Today, we take a look at the principle of indemnity. Indemnity is a principle of insurance that guarantees to restore the insured to the same financial position they were in before the occurrence of the insured loss or damage. In other words, indemnity in insurance means compensating the insured for the actual loss they have suffered, but not exceeding the amount of the loss. Under the principle of indemnity, the insured is not allowed to make a profit from the insurance policy. The aim of the indemnity principle is to put the insured back in the same financial position they were in before the loss occurred. The insurer's obligation is limited to the amount of the loss or damage incurred, and it should not exceed the amount of the policy. For example, if a homeowner's house is damaged due to a covered event, the insurer will provide compensation for the actual amount of damage suffered by the homeowner, but not more than the policy limit. The insured cannot make a profit from the insurance payment. Rather, the aim is to restore them to the financial position they were in before the loss occurred. The principle of indemnity is applied in insurance to ensure that the insured party is restored to their financial position before the occurrence of the insured loss or damage. The application of indemnity in insurance involves several key principles, including 1. The insurer's liability is limited to the amount of the loss or damage suffered by the insured. In other words, the insurer is not required to pay more than the actual loss or damage. 2. The insured must provide evidence of the loss or damage and its value. This ensures that the insurer can determine the extent of the loss and provide compensation accordingly. 3. The insured cannot make a profit from the insurance payment. The aim of the indemnity principle is to restore the insured to their pre-loss financial position, not to provide them with a windfall. 4. The insurance policy will generally specify the maximum amount that the insurer will pay in the event of a loss, known as the policy limit. 5. The insurer may choose to repair or replace the damaged property instead of providing a cash payment to the insured. 6. The insured may be required to pay a deductible or excess before the insurer provides compensation. Overall, the application of the indemnity principle in insurance aims to ensure that the insured is fairly compensated for their loss or damage, while also preventing them from profiting from the insurance policy. The principle of indemnity can be abused in insurance in a few ways, including 1. Overinsurance. Overinsurance occurs when an insured party takes out an insurance policy for an amount that is higher than the actual value of the property being insured. This can result in the insured receiving a payout that is greater than the actual value of the property, which goes against the principle of indemnity. 2. Underreporting the value of the loss or damage. If the insured party underreports the value of the loss or damage, they may be able to receive a larger payout than they are entitled to under the principle of indemnity. 3. Fraudulent claims. If the insured party submits a fraudulent claim, they may receive a payout that exceeds the actual value of the loss or damage, which goes against the principle of indemnity. 4. Insuring a property for more than one policy. An insured party can take out multiple insurance policies on the same property, which is known as double insurance. This can result in the insured receiving a payout that is greater than the actual value of the property, which goes against the principle of indemnity. 5. Insuring a property for less than its actual value. This can result in the insured not being adequately compensated for their loss or damage, which goes against the principle of indemnity. It is important to note that any abuse of the principle of indemnity in insurance is considered fraudulent and can have serious legal and financial consequences. While the principle of indemnity is a fundamental principle in most types of insurance policies, there are some insurance policies that do not apply this principle. These types of insurance policies are often referred to as non-indemnity policies. Some examples of non-indemnity policies include 1. Life insurance policies. Life insurance policies are designed to provide a set amount of money to the beneficiary upon the death of the insured. The payout is not tied to any specific loss or damage, and therefore the principle of indemnity does not apply. Another reason is that there is no amount of money that can compensate for one's life. 2. Personal accident insurance policies. Personal accident insurance policies provide a set payout in the event of the insured's death or permanent disability resulting from an accident. The payout is not tied to any specific loss or damage, and therefore the principle of indemnity does not apply. Another reason for this is that you cannot tie the loss of a limb to a specific amount. 3. Travel insurance policies. Travel insurance policies may provide coverage for a range of events, including trip cancellation, medical emergencies, and lost baggage. The payouts are often based on predetermined amounts, and therefore the principle of indemnity may not always apply. Travel accident claims under trip cancellation and accidental injuries cannot be quantified in financial terms, hence a limit is preset when purchasing the policy, just to avoid back and forth as to how much one's time, lost limb is worth. 4. Liability insurance policies. Liability insurance policies are designed to protect the insured from claims made against them by third parties. The payouts are often based on the amount of damages awarded to the third party by a court of law and any other mandated tribunal body, and therefore the principle of indemnity may not always apply. It is important to note that even in non-indemnity policies, the payouts are generally limited to the amount specified in the policy and are subject to various terms and conditions. This is the end of this particular topic. What do you think about this principle? How about the other three we have covered already? Please, let us have your comments or suggestions on them. Also, take time to watch our other videos. Have you subscribed? If not, please do so now and watch out for the next video soon.